for our webinar, Plans Giving Made Simple. Presenting for us today is Lynn Gaumer. Lynn Gaumer joined the Stelter company in December of 2011 as our senior technical consultant. Now, prior to coming to Stelter, Lynn worked as an associate attorney for 10 years with Duncan, Green, Brown, Langness, PC law firm in Des Moines, Iowa. She specialized in estate planning, probate, guardianships, conservatorships, real estate, and business planning. She received her BA in Economics and Communication Studies from the University of Iowa and her law degree from the University of South Dakota School of Law. She's a member of the Mid-Iowa Plans Giving Council and the Partnership for Philanthropic Planning. Thanks for joining us today, Lynn.
Thanks, Jen, and welcome. I am very pleased to introduce my co-presenter, Phil Purcell. Many of you have probably heard Phil speak at the American Council of Gift Annuities, or PPP, conferences. He is the Vice President for Plan Giving and Endowment Stewardship at Ball State University. He serves as a volunteer on the Tax-Exempt Organization Advisory Council for the IRS. He teaches law and philanthropy, nonprofit organization law, and plan giving as an adjunct faculty for the Indiana University School of Law and the Indiana University School of Philanthropy and Fundraising School. He's a member of the Board of Directors for the Partnership for Philanthropic Planning and a member of Stelter's Technical Advisory Board. So thank you, Phil, for joining us today. Today's agenda, we were going to first be going over the how to identify the plan giving prospects. Phil is going to be taking this portion of the presentation and is going to tap into his vast experience with dealing with donors and mining your database. Then we're going to go on to review the most popular plan giving vehicles. These include bequests, beneficiary designations, and charitable gift annuities. We will end the presentation by going over blended gift vehicles. Bill, I'm going to now turn it over to you.
Thank you very much, and it's a pleasure to join you today and to speak with everyone who's participating in the webinar. Identifying plan giving prospects is an important aspect of our plan giving work. As I often like to say, plan givers are somewhat needles in our haystack. As we look at the fundraising pyramid and think of plan giving at the top of that pyramid, we always know that the number of plan givers tend to be relatively small in number. Some organizations have different experiences than others, but generally, in comparison to the number of annual gift donors or even major outright cash gift donors, the number of plan gift donors tends to be a smaller number, but the average gift size is very large. So as we think about how we find those needles in a haystack, we do it in primarily two broad ways. One is through our marketing programs to try to draw those donors to us using our marketing materials as a magnet, so to speak. And the other way to have good plan gift prospect development is to identify prospects and then proactively approach them through individual phone calling or target mailings, or making sure we include these criteria in our mass marketing materials, such as newsletters and larger mass mailed appeals and email blasts and the like. So it's important to have a bit of a picture of the traits of common traits of plan gift donors. Age, of course, is a key indicator, and age 40 and older is an age range to consider, of course. We need to mail and promote our plan giving ideas to as broad a prospect pool as our budgets and time will allow. But if we can dig deep into, and if we are able to keep records of and maintain records of ages of our donors, and I realize this is easier for higher education organizations than other organizations who have to work hard at getting the ages of our donors or prospects. But to the extent that we know ages and can identify ages, if we can go as low as age 40 with our marketing and prioritizing, that's a good thing to do. Of course, some gift techniques appeal to older ages. For example, charitable gift annuities that we'll talk about later in today's program may appeal to those at, say, age 65, 70 and older. But in any event, keeping track of age and appealing especially to those younger than the retirement years is important. Data by Stelter and other sources, of course, show a high correlation between giving history and planned giving. Loyal annual givers, of course, are a very important pool of prospects to include in your mailings and in your visits. And obviously, the longer and more loyal the giving over a number of years, very important key indicator to keep track of. Now, for many organizations, these are traits that we readily have in our database. So you need to go through your database and look at the most loyal giving and any gift size. So loyalty of giving at even small dollar amounts might be high indicators of individuals willing to talk to you about perpetuating through a legacy plan gift their philanthropic support for your organization. Another high indicator is education, especially advanced degrees, higher education, bachelor degrees especially, is an indicator of people who are of a planning orientation. They're more likely to have perhaps a higher income level or assets. So education is a trigger for a lot of key attributes like higher income, asset accumulation, and willingness to plan and think about plan giving as an option. So income, again, we may not know the income levels of all of our donors, and a lot of individuals have wealth that we would never expect otherwise. But to the extent you can identify wealth and high income levels, these are also indicators to help you rank and rate your plan giving prospects. Also very important, as I alluded to earlier, to differentiate your prospects by age. Age is the strongest identifying trait among good prospects. And obviously, as people age, they think about their estate plan, perhaps, of course, as their children graduate from college and become self-sufficient. Suddenly now they're willing to think about philanthropy in a bigger way as part of their estate plan. And so especially then as folks retire and have even greater time to reflect and to think about philanthropy and to do documentation around wills, beneficiary designations, charitable gift annuities, any other type of instrument that might facilitate their leaving a legacy. These are all key triggers as one ages. So very important to differentiate by age. Many organizations ignore those under age 55, especially with regard to targeting bequest givers. That's a fatal mistake. We need to reach down age 55 and into the 40s because people often start estate planning when they first have children. But there are other triggers for estate planning, inheritances, buying and selling a business, a lot of triggers that might cause people to think about doing estate planning in general. And, of course, we'd want them to consider plan gifts as part of their estate planning. At the end of the day, most importantly, planned giving is about building strong relationships with your current donors. You know, as anybody on the line who's had any extended time in fundraising, you know, fundraising is all about these key relationships and, in a sense, trying to take their philanthropy to the next level. So an important consideration as we explore our relationships with donors and discuss planned giving, a good frame of reference is always to think about not only the priorities that they have in terms of taking care of their children, their own welfare as they retire and age, trying to minimize taxes, and helping important charitable causes, but also looking at the assets that individuals have to engage with this planning. So understanding different assets suitable for giving is very important. A review of these assets, of course, include both intangible, tangible property, and real estate. So assets suitable for giving, of course, includes cash. Now, if you were to look at a pie chart of what most people own, whether they're in the top 10% of wealth or not in the top 10% of wealth, cash is usually just a small slice of that pie. But cash, of course, usually is a source of annual gifts, sometimes major gifts. Cash can be used to fund gift annuities and leverage higher tax-free income, for example. So cash is a very important asset to consider, but planned giving, of course, is an activity that opens the philanthropic gate, so to speak, to all the other kinds of assets that people own. So through the planned giving conversation, we're hopefully encouraging people to think about assets other than cash for their philanthropy. You know, appreciated stock, obviously, is a very attractive asset for both outright gifts of that appreciated stock or funding trusts or gift annuities or other gifts, and even bequests through appreciated stock. But outright gifts of appreciated stock, of course, carry two tax advantages: a charitable deduction for the fair market value on the date of gift, and escape of potential capital gains tax. Life insurance is an asset that many people own. Of course, the triggering event for most purchases of life insurance are when the children are young, and we want life insurance to protect their financial future. But as children age and become economically self-sufficient, quite often this life insurance is not needed in the way it was before. So one option that your donors may consider is donating either a beneficiary designation and or ownership and beneficiary designation of that life insurance to your organization. Another asset that many people own, it's an important part of their pie chart, so to speak, of their wealth, is a retirement plan. Here again, this can be a significant percentage of their estate and makes for a wonderful venue, especially for testamentary beneficiary designations at death. So an IRA, 403B, 401K, again, these are wonderful, suitable assets for especially beneficiary designation giving. Farmland or undeveloped land, many people in our country live near and in the middle of farming communities or have donors who are farmers or own or have inherited farmland or other undeveloped land. These can be wonderful assets to think about creatively as outright gifts or funding gift arrangements like trusts or gift annuities. And then, of course, other real estate like a second home or vacation home may be wonderful venues for outright giving or remainder interest, where people designate these as a remainder irrevocably, and then at their passing, the land becomes charities. So the key is to think broadly about all the potential assets people own and thinking of planned giving as a venue for using those assets to support your charitable mission.
Okay, thank you, Phil. We are going to take a poll, and we would like to customize this presentation as much as possible. So we have a question for you. We would like to know if your organization's planned giving program is, one, non-existent, meaning that you're very reactive to planned gifts. You do not promote any type of planned gifts. You're just starting to launch your program. Maybe you're thinking about some bequests or beneficiary designations and you're starting to launch that program. You're growing your program. This means that you've already started marketing various types of planned gifts. You're looking for some maybe other educational opportunities or other ways to market these types of gift vehicles. Or you're maintaining. You're at a good spot right now, and you are marketing the planned gift, but you're not looking to grow any further, and you're on your way. So why don't you go ahead and answer, because we would like to customize this presentation as much as we can. I'm going to just give you a few more seconds here to wait for the voting to come in. Okay, here are the results. We have 14% of those on the line, and we have about 473 people on the line today. So 14%, their program is non-existent. So this is a great opportunity, and I'm so glad you're on the line today to maybe perhaps begin launching your program. 29% are in the process of beginning their program, possibly creating some marketing materials at this point. 49% of you on the line are growing. maybe you are at a point where you're looking at maybe some more complex gift vehicles, and I'll have some information for you on that later on in the presentation. And 9% of you are maintaining your program. So you're at a nice point at this point. You're marketing the plan giving gifts, and you're kind of going with the status quo at this point. So let's go on to the most popular plan giving vehicles that are out there today. These include a gift in your will or a living trust, and that is known as a charitable bequest. We will also be going over beneficiary designations, and the most popular ones are the payable on death or transfer on death accounts, life insurance, retirement plans, and commercial annuities. And then we'll be rounding out this program with charitable gift annuities. Some experts say that the average U.S. charitable bequest is worth approximately $32,000. So for those of you who are just launching your program, who are non-existent, you want to really at least focus on bequest giving. There's an enormous untapped potential here. 42% of Americans have wills, but only 9% have included charities in those wills. So there is a great percentage for you to tap this untapped potential. So let's take a look at charitable bequests. For those who are very visual, I created this slide just for you. So the donor will create a will or a living trust, and whether they create just a will or that estate plan includes a trust will typically depend on the donor's types of assets, where those assets are located, and the amount of those assets. And the estate planning attorney will help your donor decide what type of estate plan is best for them. Through that will or trust, the donor could name their family as beneficiary of their assets and also name an organization such as yours as also a beneficiary. Why are they so popular? First of all, there's little cost to the donor. When the donor sees their estate planning attorney, there is no additional charge to put a bequest in to an organization or to several organizations for that matter. So it's very easy to implement. All they need to do is work with their attorney to either create the estate plan or maybe update the estate plan. And it doesn't hurt anything financially, as we're going to see here, just by naming a charitable organization as a beneficiary of the estate plan does not hurt anything currently. They are not giving up any assets today. So for those donors who are uncertain about the future, maybe they have children going to private schools or are headed to college or are a little uncertain about health concerns as they're growing older, whether it's for them or maybe even their parents or a special needs child. They're a little hesitant to give to your organization now, but that doesn't mean that their charitable intentions are not there, and so they would like to put a bequest in for after their lifetime. So how can a bequest be made? As I alluded to, it could be made with a will, and this could be a new will. So if they don't have a will, they can certainly create a new one with the help of their estate planning attorney. Or if they have a will, they can update their will, and that's called a codicil. And if they have a living trust, they could, or if they don't have a trust, they can simply have an estate planning attorney create a new trust for them. Or if they have a trust and they want to update their trust, it's called an amendment to an existing trust. So let's go over the types of bequests that there are. There are several different types of bequests, and it's really up to your donor and the types of assets that they have of what would be best for them. So each donor is unique. They could give a specific dollar amount, so $25,000, $200,000, whatever they think. They could give a specific asset, like I will give all my Wells Fargo stock to ABC charity, or I give my piece of real estate that I own in Des Moines, Iowa, to a charity. They can give a percentage of the residue of the estate, 10% or 20%, and the residue is usually what happens after all the other gifts are made. So A lot of times they'll take care of family members and children, and then whatever's left, that part is the residue, and that would go to an organization. Many charitable organizations are named as contingent beneficiaries, and that happens when somebody else doesn't survive. So, for example, I give $100,000 to my mother if she survives me, but if she doesn't, then I give it to a charitable organization. Now let's talk about if your donor doesn't have a will. There are some pretty hefty implications here if they don't have one. First of all, the state in which the donor resides will dictate who receives his or her assets, and it's very state specific. So you have to look at your state laws to determine that. Generally speaking, it typically goes to the spouse, and then to children, and then to other family members. There is absolutely no state that has a provision in it that, in their state statutes, that gives money automatically to charities. So if you're not in the estate plan, in the will or the trust, you will not be recognized. And there's no tax saving strategies if the donor does not have a will or a trust. And this is where I think it's very important to lead by example. I encourage each and every one of you to have an estate plan and to go through that process. I think it's very important that you speak from a personal level, that you can say that, yes, I do have an estate plan. I met with an attorney. You know, it didn't take all that long. We met. They had drafts for me. And to really talk about that process with your donors who don't have an estate plan. It's very, very important that they do. And if you can talk about that on a personal level, I think that's, again, increasing your donors' trust with you and the relationship that they have with you. So if somebody is going to be interested in a bequest, they're not interested in income tax deduction. So for those donors who are saying to you, you know, oh, okay, I would really like to give to your organization, but I really need an income tax deduction. That's not really talking about bequests. We'll talk about another gift that might work better for. Now, if your donor is in an estate tax situation, now a lot of donors aren't, but in 2015, if they're over $5.43 million, they will be subject to estate taxes, and that's at 40%. And so if they're at that level and they give to charity, they'll have an estate tax charitable deduction on their tax return. And there's also no limit of how much they can give. They can give their entire estate to one charity or many charities. I've seen many estate plans where all the assets are divided up amongst many charities. So let's take a look at a case study just to kind of bring this all home. Here we have Sid. He's 67, so he's approaching or at retirement. He owns cash, stock, life insurance, real estate, which is very typical of your donors. He wants to hold on to these assets. Sid's a little bit worried about some health care coming down the road for him. He may have some nursing home expenses or assisted living, but yet he would really like to make a gift to your organization. So what's the solution? A solution is a bequest. He can bequeath a certain dollar amount or percentages of the estate. The percentages typically work better because they adjust based on the assets. You don't know what just because you have $500,000 now in your estate doesn't mean you'll have that later on at your death. So percentages typically work best. And he's allowed to keep these assets during his lifetime, and if he needs them, then he will be able to use them. So here's a general donor profile for a bequest giver. They would rather make a gift after his or her lifetime. They don't necessarily need an income tax deduction now, and maybe they don't even have the assets available to give right now. They're not looking for higher income. That would be like a charitable gift annuity, which Phil is going to talk about a little bit later. They may or may not need an estate tax deduction, and they want their flexibility to change their minds later on. So my question to you is, how are you promoting bequests? According to Blackbud, nearly 90% of planned gifts are bequests. So you need to be promoting them, especially for those of you who are just launching your program or the program is non-existent. So at the very least, you need to be promoting bequests. And this could be as simple as, please remember us in your will when you have that conversation with your donors. You can use reply cards and your website, and I'm going to go over these in a little bit. But you need to actively promote them. And if you do, you'll receive twice the dollar amount than if you don't. Prospects are donors of gifts of any size. You could have donors who make minimal gifts to your organization on an annual basis, or maybe even simply only volunteer at your organization. These are some of your best prospects. And then, with the donor's permission, if they maybe sign a letter of intent, depending on your policies, you could add them to your legacy society. So here's one of Stelter's reply cards. This is a 30-second survey that we use, and this is usually inserted in a brochure or something else that the donor would receive. And they get a little gift if they return it, so there's a little incentive there. But it asks the donor if they would, like more information or have included a gift already in their will, or would like to be contacted to learn more about making a gift. Here's an example of Kansas State University's Foundation's website for charitable bequests. It's a great website where it includes a description of what a charitable gift in your will or trust is. There is actually a little video. That's where the charitable bequest box is in the middle there. And then there's some contact information, and then they give a little example as well. So this is one great piece that your organization could use in promoting charitable bequests if the donor would like to do a little research on their own on your website. So I'm going to turn it back over to Phil, where he's going to talk about beneficiary designations. Phil?
Thank you, Lynn. Beneficiary designations have many of the same attributes as will bequests. They are revocable, they can be for a percentage, and they come at death or after the assets are not needed any longer. So consequently, as Lynn indicated, bequests are the most popular planned gift. Beneficiary designations are also extremely popular for similar reasons. There are many different types of assets for which beneficiary designations can be used. Payment on death or transfer on death of accounts, life insurance, commercial annuities, and retirement plans. Again, these are simple, fast, and convenient for the donor to do. Typically with beneficiary designations, all that is required is completing a beneficiary designation form received from the company. So one does not need to have a will created or codicil will. Rather, one uses a simple beneficiary designation form for planning the gift. Percentages work best. This way, one can leave part of the asset to charity and other parts or percentages to loved ones as he or she chooses. A beneficiary can be primary or contingent. They can be primary, be the recipient at death, or contingent if other loved ones are not living at the time of death. So let's look at some of these beneficiary designations. First of all, account designations. As indicated, a payable on death, sometimes referred to as POD, bank accounts or certificates of deposit are available from the bank or other institution where they're held, or transfers on death, TOD, of brokerage or investment accounts may be available. Now, one must keep in mind that state law governs these accounts, and so you always have to be mindful of the state law where the donor lives. In addition, the companies that actually hold these assets may have their own protocols, procedures, and forms that must be used. So one would have to ask their local attorney about any state law implications. The general donor profile for these kinds of gifts, obviously, would be someone who would rather make a gift after her lifetime without the need of an attorney. She doesn't need an income tax deduction now, so these are after-death gifts, so no qualifying for income tax deductions while one is alive. And she may not have any assets available to give now, but wants the flexibility to change her mind later on. For many of our donors, these kinds of gifts may be the largest gift they ever make in their life. Life insurance is the next type of beneficiary designation. A donor profile for life insurance would, again, be someone who'd rather make a gift after his lifetime, doesn't want or need an income tax deduction now, doesn't have an asset available to give now, perhaps, no cash, stock, or real estate that they're willing to give to charity. They may not need the life insurance policy anymore. Perhaps the children are growing up and financially independent, and wants the flexibility, again, to change his mind later on. And a gift can be made with either a new or an existing policy that's no longer needed.
Bill, we got a question here on life insurance. I was wondering if you could just take it. Our question from the group is there a benefit to the donor of transferring ownership of a life insurance policy when compared to simply naming the charity as the beneficiary?
Quite often with existing policies, if they're whole life insurance, and generally we're talking about whole life insurance policy, there can be what's called accumulated cash value in the policy. So if the ownership of that policy is transferred to charity, an income tax charitable deduction is available. It's available for the lesser of that cash value and the cost basis in the property, summation of premiums paid, but a tax deduction will be available for a whole life policy that has cash value available. In addition, if a donor makes a gift of a policy, and premiums must continue to be paid to keep the policy in force, those gifts could be made to charity because it is now the named owner of the policy, and tax deductions are available for those gifts to charity, which charity uses to pay the premium. On the other hand, only naming charity as beneficiary of a policy does not qualify for a current lifetime income tax deduction. Of course, the value of the insurance would be removed from the taxable estate of the donor. Commercial annuities are somewhat similar to life insurance. Here, again, the donor would rather make a gift after his lifetime, doesn't need an income tax deduction now, doesn't have any other assets available to give now, such as cash or stock, not looking for higher income from his assets. He's fine on an income flow basis, understands the tax benefits and naming charitable beneficiary as the beneficiary of a commercial annuity, but wants the flexibility because, again, these are revocable gifts.
Thank you. We are going to go on to retirement plan assets. And for many of your donors, these make up a large majority of their estates. So there are many types of retirement plan assets, from IRAs and 401ks probably being the most popular, followed by 403b retirement plans. These can be made either as lifetime gifts, and we're going to talk a little bit about that because there's some qualifications there. You can leave it to family, leave it to a charitable organization, or leave a portion to family and a portion to charity. So let's first talk about lifetime gifts of retirement plan assets. You can't just simply sign over your IRA or your 401k to a charitable organization. But what your donor can do is, if they're over 59 and a half, they can take a distribution from the account. They will have to recognize that as income. And if your donor itemizes, they can certainly take an income tax charitable deduction for the amount of the gift. Now, in 2015, we do not have the IRA charitable rollover legislation. We have had it in the past, which makes lifetime gifts of retirement plan assets for those 70 and a half and over a little bit easier and a little bit more tax smart. But unfortunately, it is currently expired. One of the most popular questions I get as a consultant for the Stelter company is, well, what's the status in Washington? So I thought I would take this opportunity to just give you an update. The America Gives More Act of 2015 includes the IRA charitable rollover legislation, and it does so by making it permanent. If you've been in the plan giving arena for a while, you'll know that the IRA charitable rollover legislation has been instated and then expired and then made retroactive and then reinstated and then expired and then made retroactive. I mean, we've been going through this for about 8 years now. So this particular act would make it permanent, which would be great. It did pass in the House on February 12th of this year, and it was most recently put on the Senate's calendar on April 20th, so just 9 days ago. So we at Stelter here are certainly keeping an eye on this legislation, and we will certainly update all our clients if this progresses further. However, I will say that the President has threatened to veto this legislation only because it does not have enough revenue offsets for it. So that's still being discussed, but I did want to give you that update. So let's take a look at what you can do for those donors who are 70 and a half in this, what I call legislative limbo. You know, we're once again waiting for Congress to pass something regarding the IRA charitable rollover. And if you have donors who are 70 and a half or older and have an IRA, and they would like to make a gift to a qualified charitable organization, they can certainly do so and go ahead and make that gift right from the IRA to your organization, if you're a qualified organization. If the IRA provision is reinstated under the similar parameters that it has been in the past, the distribution should not be subject to federal income taxes. But if the provision is not reinstated, the distribution will be treated as income for federal income tax purposes, and the donor can take the income tax charitable deduction for the amount of the gift. So hence, the donors, if they take the RMD, which they have to anyway, they would be in no worse position if they went ahead and made that gift. Really, they're just making sure that they would qualify in the event that it would be reinstated. And many of those donors who did that last year benefited because, if you recall, the legislation was not passed until mid-December, and that gave donors very little time to contact their IRA administrators and make the gift. So for those who did that beforehand, they certainly benefited from that. The other option for these retirement plan assets, of course, is to leave it to family. The problem with that is that they could be subject to two taxes, the estate tax and the income tax. So hence, and especially for those wealthy donors, they could be taxed twice on these assets. So we're going to go over a little example here. Jerry has $5 million, so the 401k is at $5 million. He has many other assets that put him into the estate tax area. He has 3 children that he named as equal beneficiaries, and so when Jerry died, his estate paid the estate tax, and when the distributions came to the children, they paid income tax on those distributions. So let's take a look at this. So he had $5 million in his account. 40% was sent to the government for the estate taxes. That's $2 million, which left the account at $3 million. The children, let's just assume that all 3 children were at the 35% federal income taxes. That consumed a little over $1 million in the account. The net to heirs after these taxes was a little over $1.9 million, or 39% of the inheritance value. If Jerry would have left other assets to the children and left his 401k to a charitable organization, it would eliminate all estate taxes and income tax. He'd be able to take an estate tax charitable deduction on his what's called a 706, and the charities are not subject to income taxes. So in the event that he did that, he would, if he wanted to do that, he would contact his retirement plan administrator for a change of beneficiary form. He would name either one charity or several charities as the beneficiary, and the retirement plan assets would automatically pass to the charity without any taxes. Now, probably many of your donors want to recognize family and a charity in their estate plan, and this is very common. So again, all the donor needs to do is to contact the plan administrator for a change of designation form. And the donor retains control. So in the event that they ever want to change this, they can certainly contact the retirement plan administrator again and change that during their lifetime. I think this is a very powerful slide that shows the impact of leaving a portion of your estate to family and a portion to charity. So we're going to go over an example of Jan, who has a $1.5 million estate, and $750,000 of that is in an IRA. And she would like to split her estate between a charitable organization and her daughter Sandra. Sandra is in the 28% federal income tax bracket. And most donors will think, okay, well, I have $1.5 million. I'd like to split it. So I'll just split all my assets 50-50 and give Sandra 50% and the charitable organization 50%. So if you take a look on the chart on the left, that's exactly what Sandra did. She split her IRA 50-50, her other assets, the house, securities, cash, she split that 50-50. Now when she passes, Sandra's going to have to pay income taxes on those distributions. So you can see here that Sandra, who's in the 28% federal income tax bracket, will owe approximately $105,000. So the net amount to her is $645,000, and the amount to the charitable organization is $750,000. So really, she did not treat her beneficiaries equally. But if she talks with her estate planning attorney and financial attorney or her plan giving officer, all she needs to do is kind of switch some things around. So if she leaves the IRA entirely to the charitable organization and leaves the other assets, such as the house and securities and cash, to Sandra, you will see that the charitable organization gets $750,000 because they do not have to pay any income tax on it. And Sandra receives the house and securities and cash also without paying income tax on it. And so they each receive $750,000. So you can, this is a very powerful slide, and you could show this to your donors of how they can make a gift to your organization and be tax smart about it as well. Okay, Phil's going to talk about charitable gift annuities.
Hi, Phil. This is Jen. I'm afraid you might have muted your microphone and have not unmuted it because we are not hearing you right now.
Yes, I apologize. Many organizations on the world today may have be offering charitable gift annuities, and others considering a charitable gift annuity. So if you're considering, the key question is to understand what a gift annuity is. Basically, a gift annuity is a contract between charity and a donor, and the donor gives property directly to the organization in exchange for lifetime payments from the organization, either back to the donor or loved ones, other annuitants designated by the donor. This is not a charitable trust arrangement. It's a simple contract, again, between charity and donor, and at death, the balance or residual is used by the charitable organization to support its mission. We'll reference the American Council on Gift Annuities, which recommends rates of returns that charities may consider using for gift annuities. Those rates have assumed actuarial residual value of at least 50%, assuming a donor lives to their actuarial maturity, so to speak, pursuant to the mortality tables. Now, the actual experience of the American Council of Gift Annuities and their members is a much higher charitable residual than 50%. The donor's lifetime payments are backed by the assets of the charitable organization. These are liabilities reflected on the financial statement of the charity as a liability. Therefore, the decision by an organization to engage in charitable gift annuity is a very important decision that must be factored in, taking into account all the financial aspects of the organization and its strength, and a decision ultimately by the board of directors of that organization. Gift annuities are irrevocable. Once that commitment is made, then those annuity payments are legally obligated. It's not a product sold by an insurance company. This is a legal obligation by the issuing charitable organization. The payments from gift annuities are lifetime payments. The amount is used by the donors and annuitants for their current lifetime needs as they wish. Most charities who offer gift annuities are encouraged to follow the rates recommended by the American Council on Gift Annuities. This organization has been around for many years, creating recommended rates for annuities that are based on sound actuarial and financial investment principles. A fixed amount is determined by the donor's age at the time of the gift. So if you go to the American Council website and look at the rate tables for both 1 and 2 life annuities, one can see that the older the individual, the higher their offered rate of return. Again, per annuity contract, there can only be 1 or 2 annuitants per contract. If a donor wants to offer an annuity to pay income to other individuals, new contracts would have to be created with additional gifting. If there are 2 individuals on a gift annuity contract, the income can either be paid jointly and consecutively or consecutively. So one individual could be entitled to all the income, and then at his or her passing, then to a successor annuitant. Or the 2 individuals could be entitled to the income jointly, and then when one dies, the successor is entitled to the entire payment. If your organization does not have the necessary resources for a gift annuity program, there are alternatives that you may want to take a close look at. Some community foundations in local areas might be willing to offer a gift annuity program for especially smaller charities. They may have requirements for those programs, such as a fee for their administrative costs, and they may require a residual, either all or a percentage of the residual, to reside in a permanent fund at the community foundation, perhaps for the benefit, obviously, of the issuing of a charity, the charity that's going to benefit. But you'd have to talk to your local community foundation about whether and how they may offer such a program. Another entity is the Charitable Giving Resource Center, Charitable Trust Administration Company, and there are other third-party administrators, such as banks, who might be, for a fee, willing to issue the required tax forms, to engage in the investment of the gift annuity assets, and to assure compliance with any state regulations that some states require compliance with to offer gift annuities to citizens of that state. So here's a visual showing how the gift annuity works. Quite simply, the individual, you, makes a gift of cash, stock, or other assets to a charitable organization and through the gift annuity contract. In return, the individual or other loved ones receive an income stream pursuant to the contract backed by the assets of the charitable organization. In the year that the gift is made, there is an income tax charitable deduction calculated pursuant to the approved formula for calculating that deduction. In general, that's the present value of charity's future interest. Here are some sample gift annuity rates from the American Council on Gift Annuity website. You might take note of the website address at the bottom of this slide. These rates are reevaluated every year by the American Council on Gift Annuities. They do not necessarily change every year, but one can check the website for the current rates. You'll note on the website that there are different rates for both single life and 2 life annuities. And again, as one can see, the older the annuitant, the higher the offered rate of return. So, in summary, the benefits of a charitable gift annuity: the annuity payments are owed regardless of the lifetime of the donor. A donor can never outlive the annuity stream. The assets are removed from the donor's taxable estate. The charity receives the asset immediately. Now, many charities keep those assets in an investment portfolio to generate at least some of the income available to be paid pursuant to the contract. A deferred gift annuity is an annuity where the donor makes an irrevocable gift now, today, for the annuity, but the payments do not begin until a future year. That can be quite attractive for individuals, say in their 40s or 50s, and they don't want the annuity income until retirement years. And by doing that, they can leverage a higher gift annuity rate. Gift annuities are simple 1- or 2-page contracts. The profile of a gift annuity donor is average age of 79. 70% of annuities are single life, while 30% are joint life. 88% start immediately, while 12% have a deferred starting date. So gift annuities are popular. Donors have heard of charitable remainder trust. The trust can be quite complicated to set up and more costly to set up. Gift annuities can be done for smaller amounts. Many organizations have a minimum gift annuity per annuity contract of $5,000 or $10,000, where trusts may have a much higher threshold requirement. Donors would like to have a higher fixed rate income than they currently are from any fixed rate investments. Gift annuity rates can be quite favorable in comparison to other fixed payment investment options. And donors can provide these fixed payments for other persons, children, in-laws, or valued employees. Of course, for anyone other than a spouse, one would have to consider gift tax implications. So, here's an example of a gift annuity donor, Mary, age 70, strong connection to a charitable organization, may consider donating $100,000 worth of appreciated stock with a cost basis of $50,000. Her income tax deduction is approximately $41,500, and she can deduct up to 30% of that $41,000 on her tax return and carry over any excess deduction that may be available. So the gift annuities, again, are popular also because of her annual payments. She's able to get this fixed amount. Of the money that comes back, a portion will be taxed at ordinary income tax rate, some at the capital gain rate, and some will be tax-free return of principal. And so this income will be tax-favored throughout her lifetime.
I just wanted to take just a moment to talk about blended gifts. We are hearing a lot about that just in social media and webinars and things like that. So I just wanted to end here about if you are used to talking to your donors about annual gifts or major gifts, like if you're, I know that there's a lot of people on the line here whose plan giving program is non-existent or they're just launching it. Please remember that you can do something and help your donors with blended gifts. And it's an approach where you think about making a donation today and combined with a gift in the future. And you can use the gifts that we've talked about today, such as bequests and beneficiary designations, retirement plan assets, things like that to make a gift of the future, but also remember to make the gift today. So if you're a plan giving professional and are only talking about like the plan gifts that we've talked about today, also think about how your donors can make an impact today and see how their dollars are helping your organizations during your lifetime. So I am going to take questions now. With almost 500 people on the line, you can just imagine we have quite a few questions. We will not be able to get to all of them today in the next few minutes, but I will take as many as I can. If I don't get to your question, I will either email you or call you personally and hopefully be able to answer your question. So Phil, this is one for you, and I think it's a great question, and I think it's very timely. How do you handle, is there any difference in your expertise and your experience of working with women donors as opposed to male donors?
Well, yes, there are differences. And, of course, it's hard to be you don't want to be stereotypical, of course, and everybody's different. You treat each relationship and donor differently. But, for example, with charitable gift annuities, quite often, actuarially, women in a married couple arrangement will outlive their spouse. And so, consequently, quite often, you're working with a woman donor who's inherited the assets, and perhaps they want to honor their late spouse's wishes as well, but they have their own planning priorities too. Quite often they may be particularly interested in gift annuity contracts to supplement their retirement income. There's a lot of data that suggests that women especially like to feel engaged, involved with your organization. So to the extent you have women who are volunteers on your board of directors, helping, working with your organization, they are perhaps well-positioned as planning to prospects because, again, a trait that some research has revealed is that women will give more if they feel engaged, involved, connected, so to speak, with the organization's mission.
Thank you. Here's another question. We just received a donation for $25,000 from a donor we never heard from before. She obviously is a great target for planned giving. How do we approach this with someone we don't know well?
And so they've indicated they have made a planned gift of $25,000?
Yes, or received a donation of $25,000.
Oh, so they've received a cash gift of $25,000.
Mm-hmm.
Well, obviously, whenever you receive a gift, your first action is to say thank you, and obviously they position themselves as a major outright giver, and different organizations define major gift differently, but for many organizations, $25,000 is a major gift. And so the idea here is to develop a relationship with this donor and then approach them about other philanthropic ways. A good leading question is, well, if I can show you a way to do another major gift, and if you're unable to do another cash gift like $25,000, how about a beneficiary designation or a bequest that doesn't represent a current outlay but can perpetuate your legacy down the road? So if I can show you a way to help our organization, if you cannot afford another major outright gift, would you be interested in one of these options we talked about today?
Okay, I think we've got time for just maybe one more question. Can property be used to fund a CGA? How would that look?
The answer is absolutely. You would transfer title of the asset to charity. The fair market value, you would still need an appraisal. For any deduction over $5,000, you still need to have a qualified appraisal, with an exception for publicly traded stock. A transfer of publicly traded stock for an annuity would not require an appraisal. But the hitch often is with gift annuities and assets is, it's easy with publicly traded stock because they're typically readily marketable, and you're assured that you're going to have cash in your gift annuity portfolio to reinvest to underwrite the annuity obligation. The concern with other property gifts are, will they be able to be sold regardless of what the appraisal is? Can they be reasonably sold in a period of time to generate cash to fund the annuity obligation? So the due diligence prior to saying yes to the gift is very important. Now, you've got to be careful. You cannot have a prearranged sale. Otherwise, the donor will owe capital gains tax. And a prearranged sale is a legal obligation tying the hands of charity to sell the property to a third-party buyer. But having buyers waiting in the wings, having real estate brokers offering expert opinion on the potentiality of a sale of, say, real estate, or buyers in the wings for privately held stock are perfectly fine. And charities want to be assured that they are going to be able to sell that property at a value that reflects the gift annuity obligation.
Okay, that's all we have time for today. Thank you so much, Phil, for presenting with me. If you are interested in some more presentations about gift vehicles, we have 2 more upcoming webinars sponsored by the Stelter Company. The first one is on May 13th, so save the date. And our presenter is Scott Lupkin from the University of Denver, and the title of that presentation is What Your Boss Needs to Know About Planned Giving. And the next one will be June 23rd, and that will be given by Johnny Hayes. She's the Senior Vice President for Thompson & Associates, and that gets into a little bit more complex assets, and it's called Hit the Easy Button on Complex Assets. So we hope to see you again at those webinars.
Thanks again, Lynn and Phil. As Lynn just said, we are out of time today, but as Lynn said earlier, she is willing to answer questions from you directly. If you'd like to email her email address is on the screen there, and she's happy to speak with you about your further questions on the webinar. Also, if you have more questions on any of our products and services that Stelter offers, you can email us at stel@stelter.com or visit us on our website at www.stelter.com. And finally, as an industry leader in the plan giving marketing, Stelter was very happy to provide you with this free webinar today. In addition, we will also be making the recording and the handouts available to you to access. In a few days, you're going to be getting an email from me that will alert you when the webinar materials are available. They will be on our website at stelter.com/webinars. Thanks again so much for joining us today, and we hope to see you next time. Have a good afternoon.